Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Bloom Energy Corporation Annual Report. Bloom Energy Corporation offers a range of businesses and services that cater to various industries. At the core of their offerings are solid oxide fuel cell systems for on-site power generation. These systems can convert different types of fuels into electricity through an electrochemical process without combustion. Their product lineup includes the Bloom Energy Server, which is a power generation platform designed to provide efficient and reliable electricity. Additionally, they offer the Bloom Electrolyzer, a system that produces hydrogen. This indicates that the company has a presence in both energy production and hydrogen generation. Bloom Energy Corporation serves a diverse range of industries through direct and indirect sales channels. These include utilities, data centers, agriculture, retail, hospitals, higher education, biotech, and manufacturing. Their products are designed to meet the specific needs of these sectors, providing them with efficient and reliable power solutions. The stock price of Bloom Energy Corp has skyrocketed by over 544.66% in the past year due to a combination of factors. The rapid expansion of artificial intelligence, AI technology, has led to an unprecedented demand for on-site power solutions, particularly in the data center industry. Bloom Energy's solid oxide fuel cell technology has emerged as a crucial solution to meet this demand, positioning the company at the forefront of a generational growth opportunity. Strategic partnerships have also played a significant role in driving Bloom Energy's stock price upwards. The company has entered into major partnerships with Brookfield Asset Management, Oracle Corporation, and American Electric Power, AEP, solidifying its position as a key on-site power provider for data centers. These partnerships have not only validated Bloom Energy's technology, but also provided a significant boost to the company's revenue growth. Bloom Energy's strong financial performance has also contributed to its stock price surge. The company reported record revenue growth, with a 37.3% increase in annual revenue from 2024 to 2025. Additionally, Bloom Energy demonstrated improved profitability, moving from an operating loss in Q3 2024 to an operating income of $7.8 million in Q3 2025. The company's optimistic outlook for 2026, with forecasted revenue growth of 60%, has further contributed to investor confidence and market momentum. Analyst upgrades and increased price targets have also played a significant role in driving Bloom Energy's stock price upwards. Overall, the combination of strategic partnerships, strong financial performance, and increasing demand for on-site power solutions has driven Bloom Energy's stock price surge over the past year. Bloom Energy Corporation market capitalization of $43 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Bloom Energy Corporation holds a significant advantage in their industry. Bloom Energy Corporation trades at a higher price-to-book ratio of 56.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 78% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through several key factors. Successful sale and leaseback transactions and sales of new PPA-V energy servers were significant contributors to revenue growth in 2023 and 2024. The release of deferred incentive revenue, service revenue from operations and maintenance, O&M agreements, and a sales-type lease also contributed to revenue growth. Additionally, the derecognition of financing obligations related to terminated legacy managed services agreements resulted in a substantial gain, contributing to revenue growth. Repowering of old energy server systems with new ones, financed by a new financier, was another factor that contributed to revenue growth. Revenue from related parties, particularly the Korean JV, was also a significant contributor. On the other hand, the decline in revenue in the United States segment and growth in the foreign segment were primary drivers of revenue growth or decline. Other factors such as impairment charges, equity in earnings, loss of unconsolidated affiliates, deferred profit in transactions with unconsolidated affiliates, and cost of revenue and cost of product revenue may have also contributed to revenue growth or decline. Net income experienced a significant decline between 2023 and 2025, with a total decrease of $58.1 billion. This downward trend was also observed from 2024 to 2025, where net income decreased by $730,000, or 36.1%. Furthermore, equity method losses in 2025 added to the overall decline in net income. The profit margins showed mixed results during this period. While total gross margin increased from 27% to 29%, product gross margin decreased from 37% to 35%. The gross profit margin fluctuated between 14.8% in 2023, 27.6% in 2024, and finally settled at 29% in 2025. Operating profit margin also experienced a significant increase from -15.7% in 2023 to 1.5% in 2024, but then decreased to 3.6% in 2025. The reasons behind these changes are not explicitly stated in the provided text, leaving room for further analysis and investigation into the underlying factors contributing to these shifts in net income and profit margins. The company's financial performance indicates a significant achievement in its ability to generate cash. One of the key indicators of this success is the generation of positive operating cash flow. This means that the company is able to produce more cash than it consumes, allowing for investments and debt repayment. This positive trend is evident throughout various sections of the report, where it is consistently stated that the company is generating positive operating cash flow. The repetition of this statement underscores its significance and reinforces the notion that the company's financial health is on a stable footing. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, there was a substantial increase in debt from 2024 to 2025, with a rise of approximately 133% to $2,613.7 million. However, by June 2029, the debt had decreased significantly, but then increased again to $19,837. In terms of interest expenses, there was a notable decrease of $8.7 million, minus 14%, from 2024 to 2025. This trend continued in 2025, with an interest expense of minus $53,888,000 compared to minus $62,636,000 in 2024. However, by 2023, the interest expense had increased significantly to minus $108,299,000. Despite these fluctuations, it is clear that the company's debt level and interest expenses have undergone significant changes over the past few years. The initial increase in debt was followed by a decrease, but then an increase again. Similarly, the interest expenses decreased initially, but then increased in 2023 compared to 2024. The performance of various segments and regions has been a mixed bag for the company. Internationally, several markets have underperformed due to various reasons, such as reduced demand in the Republic of Korea, expiration of incentives and procurement programs in Europe, and heightened risk of regulation affecting fossil fuel-based products. The international market's poor performance is further exacerbated by potential financial strain on foreign subsidiaries. On a more positive note, the U.S. market has been a standout performer, bucking the trend of international markets. Domestic assets have also performed well, with substantially all granted as collateral, indicating strong financial health. This contrast between domestic and international performance highlights the need for tailored strategies to address regional challenges and capitalize on opportunities. The management's outlook for the company is optimistic, with a focus on driving revenue growth and improving profitability. The significant 37% increase in revenue from $1.473 billion to $2.024 billion demonstrates the company's ability to expand its market share and capitalize on emerging opportunities. Furthermore, the improvement in gross profit margin from 29% to 39% indicates that the company is becoming more efficient in its operations. The management's strategy is centered around investing in innovation and technology to maintain the company's position as a leader in the clean energy industry. This is evident through the formation of joint ventures with SK Ecoplant and Brookfield Asset Management, which will support the company's growth and expansion plans. Additionally, the prospective financing framework structure with Brookfield Asset Management for up to $5 billion over 5 years will enable the company to fund future Bloom Energy fuel cell projects. Overall, the management is committed to driving growth, improving profitability, and investing in innovation and technology to ensure the company's continued success. By focusing on operational efficiency and strategic partnerships, the company is well-positioned for long-term sustainability and expansion. The company has made several significant acquisitions and divestitures over the past year. In terms of acquisitions, the company has purchased a 9.9% equity interest in Bolt US Class A JVCO LLC and Bolt US JVCO LLC, as well as a 15% equity interest in Orc Holdco LLC. Additionally, the company issued and sold shares of non-voting Series B RCPS to SK Ecoplant for $311 million and received a loan commitment asset from SK Ecoplant worth $52.8 million. On the other hand, the company has also made several divestitures. The leases on 2 facilities in California were terminated, including a 60,000 square foot manufacturing, warehousing, and R&D facility in Sunnyvale, and a 44,000 square foot R&D facility in Mountain View. The company also sold an operating company with a portfolio of PPAs, as well as energy server systems to countries such as the Republic of Korea, Japan, India, and Taiwan. Furthermore, 3 separate PPA agreements, PPA YEA, PPA IV, and PPA V, were sold in 2022 and 2023. Finally, the company released its obligation to close on an original transaction valued at $76.2 million. The company's financial activities over the past year have been notable for several key developments. One significant aspect is its dividend payments to shareholders. The company has indeed paid dividends, with a total payout of $0.9 million as recorded on page 61 of the financial reports. In addition to paying dividends, the company has also engaged in share buybacks. This strategy involves purchasing back shares from existing investors, which can help boost shareholder value and reduce the number of outstanding shares. The company's decision to engage in multiple share buyback transactions across various pages, including page 45, 51, and 59, underscores its commitment to this strategy. Overall, these financial activities demonstrate the company's efforts to reward shareholders through dividend payments and enhance their equity stake through strategic share buybacks. Concerns about inventory buildup and supply chain disruption are prevalent in various aspects of a company's operations. One of the primary concerns is the strain on global supply chains for certain raw materials and components, page 30. This strain can lead to delays, shortages, and increased costs, ultimately affecting customer delivery and order cancellations. Furthermore, there are risks associated with inventory buildup due to supply agreements that could expose the company to excess inventory, insufficient inventory, above-market pricing, or higher costs, page 21. Additionally, sole suppliers for capital equipment may experience financial difficulties or go out of business, disrupting production schedules and increasing costs, page 31. The company's reliance on third-party providers of storage equipment, infrastructure equipment, and pipelines also poses a risk to supply chain operations, page 56. Trade tensions between the U.S. and China could impact sourcing of rare earth metals and components, further exacerbating supply chain disruptions, page 47. Inventory levels have increased significantly, with raw materials inventory increasing by $36 million, work-in-progress inventory increasing by $45.4 million, and finished goods inventory increasing by $17.2 million, page 117. This buildup in inventory may be due to purchase commitments with suppliers and contract manufacturers that are not cancelable, indicating potential supply chain risks, page 156. Overall, the company faces significant concerns about inventory buildup and supply chain disruption, which can have far-reaching consequences for customer delivery, order cancellations, and increased costs. That concludes the financial summary for Bloom Energy Corporation. Feel free to comment below, and I will be happy to answer them when possible.